Luke Tilley, will the volatility we've been seeing in the market since the start of the year keep the Fed on hold? Because Wall Street was actually looking for 3, maybe 4 rate hikes this year.
I don't think that the volatility in and of itself is going to keep the Fed on hold. But the fact of the matter is that we've seen oil prices come down quite a bit, and that's really going to affect the inflation forecast going forward down through 2016. In Wilmington Trust, we've reduced our inflation forecast to a lower path over the course of 2016. And I think that that is really what is going to keep the Fed on hold, because they even said in their most recent statements that future rate increases will rely on projected but also realized measures of inflation. So I think that that will end up keeping them on hold, and they'll try to message that a little bit later today.
Still, there's lots of recession talk in the market. You see growth of 2.5% this year, despite what we've seen in the markets. How do you get there?
We have a forecast of 2.5% growth, as you said, for this year, but we recognize that there are risks to that forecast. There's increased recession talk, certainly, as we've seen a lot of the market volatility since the start of the year. But I think if you were just looking at the economic data, you wouldn't hear so many people talking about a recession call. But because what we see is increased consumer activity going forward, buttressed significantly by the increase in jobs and by those salaries. On the investment side, we actually had stronger investment outside of energy. So in all the other sectors outside of energy over the course of 2015, that big drag from energy is expected to disappear over the course of 2016. So that stronger investment from other sectors should show up and raise the headline. And then in addition to that, we should see a little bit of contribution from federal government spending, which we haven't had over the most recent years.
What about the weakness from China? We heard last night from Apple that their results were affected by weakness in China. Can a slowing China drag the U.S. down?
Well, certainly this is the biggest risk to the forecast. It's a weakness in China, weakness in emerging markets, and to what degree would we have the spillover? So we recognize that this is certainly a possibility and a risk to the U.S. forecast. But it's also very possible that the U.S. escapes and heads off with very strong growth in 2016. So we've seen many times over history where an appreciated dollar has weighed heavily on emerging markets, and still the U.S. economy did fairly well. The most recent and obvious example is 1997, 1998. We had a very strong appreciation of the dollar then, very similar to what we've had over the past couple of years. We had a very weak manufacturing sector in the U.S., very similar to what we have now. And we had the Asian financial crisis, but still a strong domestic U.S. economy was able to overcome that weakness.
Will oil make a comeback, and will it be good or bad for stocks? Because a lot of this recession talk is because that oil's real low and you're not getting a lot of productivity to use that oil. And then other people say it's just a supply problem. Where do you come down?
Well, we believe that the oil price decline that we've seen since mid-2014 really actually had 2 different parts to it. At first, it was certainly supply. It was an oversupply that we started seeing late 2014 and into 2015, U.S. being a large increase in production on the margin, and that supply increase really weighed on oil prices at the beginning. Since mid-2015 or so, it looks more like a demand situation. You have the devaluation of the Chinese currency in mid-August of last year, and since that point, real fears about weakness in emerging markets and real fears about how strong China's economy really is. And I think that that has really been a demand side weakness for oil prices. We think that the supply side situation is going to remedy itself a little bit in the second half of this year, and we should see oil prices come back based on that. But we also have the wild cards of new deliveries from Iran and then how strong demand actually is.
And a lot of those real fears are also manifesting themselves in the 10-year Treasury. It's now below 2%. It's 1.99, 1.98%. Where do you think the 10-year is going to be at the end of 2016?
Well, if our forecast holds with economic growth, then we should start to see some of these fears and this fleeing into safe haven assets disappear over the course of the year. And that would translate to Federal Reserve rate hikes over the course of the year, probably not 4 like they've communicated, probably more like 2 or 3. And that would have the 10-year Treasury moving up to about 2.4, 2.5% by the end of this year.
All right. Well, thanks a lot, Luke Tilley.
Thank you, Greg.
And thank you for watching The Street.